Joining us now, Stephanie Link, Chief Investment Strategist and Portfolio Manager at Hightower Advisors, as well as a CNBC contributor. Steph, good morning.
Good morning.
You know, I mentioned we had this near round trip, not quite in the S&P 500, but over the course of the last month plus, obviously some things got shaken loose, maybe some new themes emerged. What's your current read on whether, you believe this recovery or has the nature, the leadership of this market changed in the last few weeks?
Well, I think a lot of the reason why we did bounce back, Mike, was because the economic data here in the States has been pretty good. You're running at about 2.5% GDP when you add all the various different pieces together. So it started 2 weeks ago with the ISM services, new orders, employment, all were better than expected. And then you had 2 weeks of decent weekly jobless claims. They're certainly trending higher, but it's not out of control, and it's nowhere near a recession. Inflation, you're now at the lows that we haven't seen since March of 2021, and you had this great retail sales report. And so you kind of add it all up. And then I really have to put a lot of emphasis on Walmart's report, because they did a 4.2% U.S. same-store sales number in the quarter. So hardly a deteriorating consumer. And sure, they're taking market share. I get all that. But the consumer is hanging in there, and that's 70% of our economy. So I also think that Warren Buffett buying Ulta and Pershing Square buying Nike also just led to a lot of confidence. So this is a lot of good things going on.
I guess the question now is, okay, we're back up to within 2% in the S&P of the record highs. You have other parts of the market like semiconductors that are actually lagging. And, you wonder if we've sort of rebuilt the valuation. We definitely had a shakeout of very crowded positioning and all the rest of it. And we did have that growth scare that you mentioned after the bad jobs report. But I guess the question is, can you sound it all clear? Earnings have actually started to broaden out, earnings growth. That's been noted a lot as people are summing up the second quarter results. That seems like a positive. The question is whether the market's figured it out already.
Yeah, no, I think that you can still find value elsewhere beyond tech. I mean, I still want to have exposure to tech. And in fact, 2 weeks ago, I was actually adding to my Lam Research position when it fell, like in 2 days, 15% for no reason. And the good news is that we just got through with earnings. We just got through with guidance. And so I have a lot of confidence in buying the weakness, and that's what I was doing. So, it's Eaton, it's Lam Research, it's Bank of America, it's Truist Financial. I bought 2 new positions last week, CrowdStrike, because it's down 41% from its high, and Chipotle, because we know what happened with Brian Niccol leaving and going to Starbucks. I mean, that stock went, it was down 30% from its high. And so I think that there's a lot of places that you can pick and choose from.
Eaton, I would say, as well as Truist. I mean, so clearly you expect that this expansion is going to go for a while, right? I mean, your basic premise is that the economy, we kind of had a freak out about it, but really it's not that vulnerable, I assume. How much do the potential for Fed rate cuts filter into that, and whether they're kind of necessary or not?
Well, I think we're expecting the Fed to do something in September, whether it's 25 or 50. It's going to depend on the job report and a couple of the weekly initial jobless claims that they'll keep an eye out for. But I think it's just that they're going to signal they are beginning a cycle. And that's important. And at the same time, growth has hung in there. So like the definition of soft landing, I think, that's kind of what I'm thinking it's going to be. And I don't think that there's any reason not to think that way, given all the economic data, given the earnings and the trajectory of earnings and the guidance going forward. I don't think there were many people that expected this past quarter to see the S&P 500 earnings be 11.8%. And so I think, maybe it doesn't stay that high, but I think 8 to 10 is very reasonable. And as I mentioned, a lot of these other companies that are down with good valuations where earnings are going higher, I think that there's a lot of places that you can pick and choose from.
We'll hear for a couple more big retailers this week. I guess one question that could be answered is whether Walmart is exceptional when it comes to its ability to actually outperform in this environment.
100%. They are executing flawlessly. They have the traffic. As I mentioned, they have the same store sales. Target will be very interesting. Expectations are very, very low. The stock trades at 15 times earnings. I think the bar for comps for Target is at 1.5% positive. But there's a chance they guide down because the expectations in the second half are for 2.5%. And I'm just not sure you're going to get that, but we'll have to see. They have a lot of levers in terms of margin growth and expansion, and as I mentioned, the valuation is very attractive. TJ Maxx will be interesting too. They've obviously been the beneficiary of kind of that trade down, and they have too executed very well. Usually that stock trades off when they report earnings, so that's always a good time to pick up some.